Press the bell icon on YouTube and don't miss another update.
Hi, welcome to Economics. It's almost a week now since the union budget was presented by Finance Minister Nirmala Sitharaman, her first one. Economists, policymakers and the markets have digested it now. It's been analyzed threadbare. The markets are not too happy about the budget. The slowdown remains a fact of life and everybody is now waiting for the measures announced in the budget to start bearing fruit. And that will take some time, as we know. There is no magic pill to fix the slowdown. One of the historic announcements or a bold move announced in the budget was that India will now borrow from abroad. To discuss the implications of foreign sovereign borrowings, what they mean, why they're historic, and what could be the pros and cons of this bold move, I have with me Professor Ila Patnaik, our columnist, who has also written her piece this week on the same subject. So, Ila, welcome to another episode of Economics. You've called foreign sovereign borrowings as a bold move. Historic in a sense. Why do you call it a bold move?
You know, after 91, when we had a balance of payment crisis, triggered particularly because we had a lot of foreign debt and were unable to pay back the debt. We barely had 15 days of reserves left. There has been a fear in the Reserve Bank of India and in government, a fear of foreign borrowing. Dollar borrowing particularly, so it should be foreign currency denominated or dollar denominated borrowing, and that is why I call this a bold move. That many times this proposal has come up in between, and while we've allowed on the one hand we've allowed foreigners to buy Government of India rupee bonds, but this is the first time when we are saying that we'll go out and the Government of India will borrow from abroad.
Directly. And what was the need to do that at this point of time, considering we've not done something like this in the past where things have been even worse for the economy?
So there are many reasons. One is that you have a large amount of borrowing. A lot of households' financial savings are being borrowed away by the government. So that leads to crowding out, in the sense that you also want the private sector to be able to borrow. And today, if the government in fact borrows not just in the market but mandates banks to invest in SLR, which is government bonds, LIC, other financial institutions, insurance companies, they have to put their money into government bonds. Household financial savings have not been increasing much, and today when you want to push up the investment rate, and this talk about pushing up investment in infrastructure particularly, which India definitely needs, and taking it to much higher levels than at present, means you need to have the money, and that amount of saving is not available domestically, so you want to borrow from abroad. So that's one reason to borrow from abroad, and the time is in that sense it's timely because household financial savings have gone down while our aspirations to invest more, particularly in infrastructure, have gone up. So whenever we want to have investments greater than saving, the resources have to come from somewhere, and so that's one reason. I think another important reason is that at this time international money markets are awash with liquidity. Emerging economies are able to borrow at cheap rates, and India is one of the fastest growing economies in the world. So foreigners would want to invest in the risk-free government bond that we might offer.
But you've also said that in the past India was terrified of borrowing from abroad. Why? What? Explain this fear.
So, as I said, after the 91 crisis, the balance of payment crisis, we felt that if we
That was when Chandrasekhar was the Prime Minister and Yashwant Sinha was the Finance Minister.
That was long ago when, most of us, and I think most of the people watching this video weren't even born then. But what really happened was that India had done a lot of short-term dollar-denominated borrowing. So, there were high imports, and exports weren't doing that well, and so we borrowed short term to get to be able to finance our imports. That really gave us a situation where we didn't have much reserves because we weren't really open then and we didn't export much, nor had we allowed foreign capital to come in, neither debt nor equity particularly. The debt I'm talking about was trade credit, short-term credit. So we had a lot of that, and then our policymakers had to go with begging bowls to the IMF, accepting conditionalities, saying we'll do whatever the conditionalities are because we can't survive. We had to shut down on many imports, restrict oil imports. We had to put in a lot of restrictions because we just didn't have the money to borrow to repay our debt, and our debtors were saying they will no longer roll over our debt. So this fear that somebody can say we're not going to roll over your debt is something that persisted. In terms of how we would finance our investment higher than our savings rate was that we put in place a hierarchy of capital flows almost. So we preferred equity to debt. Within equity, we preferred foreign direct investment to portfolio investment. Within debt, we preferred long-term debt to short-term debt. So, we put in this hierarchy where dollar-denominated debt, and particularly by the sovereign, was done only when there was a crisis of sorts. Then we would do these NRI borrowings and Millennium India Bond and Resurgent India Bond, which would be that you tell NRIs we'll offer you a higher interest rate and therefore attract that money, not through the market.
So you mean to say that, at this point in time there is no fear that we might end up borrowing too much? Also, Mr. Garg, I think, has said that it's only 10% of our total borrowings. That's about 70,000 crore or something.
Yeah, so I think, the approach seems to be that we'll go slow, we'll see how the market reacts. And so one advantage of doing this is that you'll get cheaper money. But then there's always a currency risk that you're taking. So you don't want to borrow too much. If you did, then the world might perceive that your exports aren't doing so well and you may not be able to return the money. So it is, good to be very cautious about it. It also should not lead to borrowing more. That yes, given that we stick to our targets of say 3.3 of the fiscal deficit, a part of that borrowing to diversify, to get cheaper loans, as well as to set a benchmark for the corporates, the risk-free rate benchmark.
India has borrowed, through the other kinds of bonds from abroad. You talk about the Resurgent India bonds, the Millennium India bonds, and then of course the private banks have their masala bonds afloat now. And you talk about how RBI will compensate banks where the foreign exchange differential comes into play.
Not now.
But in this case, they had done that in the past.
They had done that in the past.
But in this case, in the fresh borrowing, what will happen when the foreign exchange differential comes into play? Who will pay for that?
In principle, it should be the government that takes that currency risk. That the government, when it borrows in dollars, like if you were to borrow in dollars or any corporate was to borrow in dollars, then really if the rupee dollar rate moves, we have to pay back in dollars whatever might be the rate. So in principle, here the government will be holding the currency risk.
A very key point you make towards the end, Ela, is about getting people to trust our data so that they are willing to buy our bonds. And that has been an area where there have been some concerns. So why is it important? Can you tell us why the credibility of data is important for foreign investors to trust us to buy our bonds?
So if our data is not good, let's just assume that there are problems with the data, there's lack of transparency. Even if we believe that it is good, we do need to put in enough transparency that people believe the data that we are putting out, because otherwise they might think that actual borrowing is going to be much more, and when actual borrowing is more, yields are going to go up and bond prices are going to go down. So it may make them averse to holding our bonds. They may ask for higher returns when holding our bonds. So again, we won't get the best deal out of it. So, if you look at it in terms of macro stability, what you need is a stable debt to GDP ratio. I mean, it's almost like if I have loans that grow faster than my income grows, then my debt to GDP ratio is something like that, in that I will not be able to eventually return and repay and service my debt. And this really depends on whether the interest rate is higher or the growth rate is higher, right? So if the growth rate of GDP is high and the interest rate is low, then your debt to GDP ratio will remain stable. So you need good GDP data, you need good fiscal data, you need people to believe your data. You need them to have trust that if you've put out a debt to GDP number, if you've put out a GDP number, if you've said I am borrowing so much, then it includes your off budget borrowing, it includes any deferred payments or delayed payments that governments sometimes often resort to, so that they can get the fiscal deficit number right. So you want them to see good data. Otherwise, it's a bit like the lemons problem, where second-hand cars don't get good prices because people think that it might be a lemon, there might be a problem with that. So you need transparency as much as possible.
So typically, what kind of returns can investors expect in sovereign bonds?
So currently, in dollar terms, you could get as much as 2-3% in dollar terms, but it depends on whether it is expected that you default or whether you don't. So that can really make a difference.
But are you confident that this issue will, there will be several issues, it's not one issue, will be subscribed well or undersubscribed, oversubscribed?
So I'm pretty sure that if we float, if we issue bonds, we will get a very good response. But I worry that if we do it without adequate fiscal discipline, without adequate fiscal transparency, and without very good data, then very soon it could become a problem. People could mistrust it. So they could be putting in money and taking it away if some good news or bad news comes. So when there is mistrust, it's very easy to trigger a panic. And so I think a precondition, a necessary condition, a prerequisite for floating or for issuing foreign currency denominated sovereign bonds is fiscal discipline, fiscal transparency, and good GDP data.
Fiscal discipline, fiscal transparency, and good GDP data. We'll see how that goes in the coming months. Thanks, Ela. That was a very, very clear articulation of something which is so technical. You should watch our previous episode of Elanomics also, which talked about all the various terms which get used so often in our pieces, in our discussions, in our comments, to simplify them. Thanks for watching this episode. We'll be back with one more next week.